Good morning. This is Brad Olson with Oaktree Financial Services. I'd like to welcome everybody to our State of the Markets webinar. Our concept here is to really kind of do a little overview of where we're at as far as the business cycle, the economic conditions, talk a little bit about what's going on in the portfolios, but really get a chance to update overall kind of our thoughts and make sure that we're communicating with clients and with everyone as far as what's going on currently as far as our thoughts on managing money. So I'd like to try to keep this to around a half hour to 45 minutes. We do have a Q&A section. If you do have any questions, feel free to enter those questions and we'd be more than glad to answer those at the end. I'm going to try to grab those at the end of the seminar and get a chance to go through them. So I'm going to keep this moving along. So again, if you have any questions, feel free to let us know. So as we look down, I mean, some of the important things that we're going to be looking at is basically what's going on with the overall economy, what we're seeing from the standpoint of just the overall perspective of what we have. Now, I just want to let you know, we do record these and we do post these to our website. So just giving you advance notice of that. So you know that if you have any questions, they will be recorded into our session. Again, feel free to call or email us at any time. Let us know if you have any thoughts on your mind, things that you'd like to talk about, some of the things we're going to highlight today. If you have questions on those, feel free to reach out to us and we'll cover those. The first thing I want to talk about today, which I think is probably, I'm going to start with what I think is the most important part of what we're going to discuss over the next half hour, is what I call the bucket strategy. Now, what I mean by the bucket strategy, as we go forward, you're going to find that we're going to continue to experience market volatility. It's just the way the business cycle works. But the most important thing that we can do in a financial planning process, in the investment process, is being wealth managers for you, is to make sure we understand this strategy. So if it's something that we need to talk about, feel free to call and let's go through this. And as I'm talking to you and reaching out and doing reviews, this is something that I want to make sure that we're always on the same page on. Now, the concept behind this is that basically we divide money into three buckets. So when we're looking at your investments, we're looking at your money, what you have to invest, what you have to live on, either in retirement or approaching retirement, into three different buckets. And those buckets really are going to be more of a short-term look, more of an intermediate look, and a longer-term look. Now, the concept behind this, and actually what we've done, I'm just going to hold this up. We put together a worksheet that we can do with you to go over this idea to make sure that we understand how much funds we need in each bucket. Because the concept here is the 1 year, the near-term bucket is for really relatively liquid money. Your emergency reserve is the money that you need to live on. Any bigger expenditures we're planning in the next 1 to even 3 years, if we're planning on spending money, we need to know that. We need to make sure that that money is prepared, so we don't have to liquidate things when they're down. And currently, we're going through that part of the business cycle. We need to make sure we have that. Also included in this first bucket is part of the second bucket, which is cash flow. If you're taking an income out, for example, I was just working with a client, we're going to be taking out around $50,000 a year in income that we need to generate from the portfolio. What I want to do is I want to have at least 3 years or $150,000 in that example set aside so I can get at that money without having to liquidate any assets that I wouldn't want to liquidate if they're in the part of the business cycle where we're experiencing a downturn. So that's a very important part about what we do, is make sure that we're talking about this whole concept of what's going on with the bucket type of investing. So we want to make sure we have that cushion. We want to make sure we have that income. We want to make sure we have that, anywhere from 6 to 12 months of expenses set aside, or income, depending on which way you look at it. We want to have that money relatively liquid. And that does change how we invest it. As we look at this, we need to match your goals, both in retirement and before retirement, to make sure we understand where that money is and how we're going to tie it up to a degree in that investment process. Because when you buy a stock or you buy a bond or anything you go into from an investment standpoint, that's the one question that we always ask. I know we do a lot of talking about goals, time frame, risk tolerance, how you feel about ups and downs in the market. To me, probably the basic question we always need to make sure we're asking is, when do we need to liquidate money to provide for your goals, for your retirement, for what you're trying to do. So that really is the number one thing that we need to focus on, is making sure we're matching to that. So that, I wanted to make that very clear kind of right up front. I didn't want to gloss through this at the end as if we got a little short on time. So we need to make sure that we're communicating on this subject. And I'm going to be asking this question of every client to make sure that we are on that same page, because to me, it is the most important part of kind of the planning process. Very simplistically, is this bucket theory. The next thing I want to talk about a little bit, and you'll hear me go on about this quite a bit, is the business cycle. What we're experiencing right now really is the classic business cycle. What you'll see is every couple of weeks, I'll put out an update of kind of where I think we're at in the business cycle. And I take this from several different sources. When you're looking at it, what we're experiencing now really is a classic part of the business cycle. When you're looking at investing, what you're seeing is this really is, and what the economy does, this is what happens. Another document that I had put together is really a longer description of this. And what I'll do is try to mark where we're at in the part of the business cycle. And what this does is it kind of gives me my roadmap. I go back to kind of my key to my map, which is a paper that I had developed many years ago and taken from, again, from different sources, to talk about when we're in a certain part of the business cycle, what does that usually do to the investment strategy? How should you be invested? And what it does tell me is it gives me an idea, for example, of what is the outlook for the economy. For example, right now, I have us in kind of this part 3, and actually I have 8 different pieces of this that I look at. So each one of these is subdivided a little bit more when I'm looking at it more detailed basis. But really what this says, the economy is weak. Some analysts are beginning to talk about the possibility of recession. The foretelling business likely to improve, however, are still heading lower and point to weak economic conditions. So it's exactly doing what we thought it would do. Now, the question we have, and this is the $64 million question when you're looking at investing, because my comment would be to me, if we knew where this was exactly, and we knew the timing of this, why wouldn't we just react with more of a market timing theory? The problem is you have an idea of what's going on when you get in these cycles. The problem you have is you don't know when you're getting in and out of it. It's a very dynamic process we have in our economy. It's a living organism. And that organism is going to find that it's going to fluctuate on how quickly it goes through this parts of the cycle. So, I mean, I'm sitting there with the Fed white paper. This is the Fed white paper that they put out from the meeting last week. And I've determined one thing. I think we probably have as good a clue as they have, and they have a lot more people working on this. When I look at the concepts of what the Fed has done as far as the monetary policy, I think the general consensus in the nation is that we probably were late to the game on raising interest rates. We should have not probably put as much cash in the system as we put in the system. But again, in defense of the Fed, you don't know these things until they happen. If we did, this would be a much easier situation that we could work through this process. So you really don't know until you're honestly looking in the rearview mirror. But it does give you a template. This roadmap does give you an idea. I know where I'm heading. I know what's going to happen. I just don't know how quickly I'm going to get there. And if you're driving to somewhere, we know how we're going to get there. We just don't know how quickly it's going to happen, how many road bumps there's going to be, how many bridges are going to be out, and we have to take a different path for a little while. That's what happens with this business cycle. And we have seen that sort of thing is somewhat predictable from the standpoint of going through this cycle. That's why I'll always go back to that. It gives us kind of a base idea of how we should be invested at various parts of the cycle. So that is an important part. Now, the next slide I want to cover is really talking a little bit about inflation. You'll see here, for example, that inflation has heated up significantly. You look at the headline CPI numbers, where we're at right now. You look at core, which is stripping out, food and energy, which is a tough one to take out of there. When you're looking over here at some of these numbers, you can see we've had a massive increase in inflation. Now, what is inflation when you start breaking it down to its simplest forms? You have supply and demand. When the demand forces up prices, or there's a shortage in supply of those goods and services that we're purchasing, that drives up inflation. Then we throw in the concept of throwing in a lot of money, which is supply. You're throwing a lot of money into the system to go after a certain limited number of goods with the supply chain problems we had. That really was a recipe for seeing inflation come to the levels of what we had. Now, I have never agreed completely with stripping out and going to core. The concept is that day to day, month to month, that various energy costs and food costs can be very fluctuating. Bottom line, for most of us, this is a big part of what we do as far as overall what we spend. Now, also there is the Russian situation. I don't want to say that that is not a part of this. When you look at inflation, there is no doubt that what we've seen, especially with some of the food pricing as we go forward, that there is no doubt that the whole Ukraine situation, that whole area of that part of the world is called the breadbasket of the world for a reason. It does produce a lot of wheat and grain that we use in a lot of production across the world. So you throw into all these things into play, plus the easy money supply situation, that really caused this to happen. So it's not a complete surprise. Now, the question was, if we would have taken action earlier, could we have held this off? And that's something that I think, in general, most economists are agreeing that that is the downfall that the Fed did not do. Why they didn't, again, it's not a science. It is an art form to a degree. When you look at, I mean, I'm even going back and looking at some of their estimates that they have in their minutes, and even going forward again, they give themselves a pretty wide variance of what their estimates are going to be. So when we're looking at this is going to take a while to get under control. And we'll talk about that as we go forward, what that means. When you're looking at inflation, I thought this would be an interesting concept to just show what makes up inflation. You can see, for example, if you look at these numbers here, you can see on these higher rates, what makes it up. The green is energy, cars, food, restaurants, shelter, which is a big part down here. You can see what makes up our inflation. Now, one of the things you'll notice here, the green has gotten bigger. The red has gotten a little smaller, but that was a big part of inflation here as we had this shortage of cars. We drove up all the used car rates. We drove up all the new car rates. Just personal story, I'm getting to a point where my 2013 Traverse is starting to cost me a lot of money. I'd love to upgrade somehow, but I'm not going to pay a $4,000 upcharge fee for a hybrid right now. But those are the questions that we have to look at when you look at where is inflation coming from. So there's no doubt that this is a major factor. And the problem you have is that does then penetrate down to all these other things. So energy has been a part of that formula. And that's why it's such a political football right now that everybody wants to see it come down if they want to be elected, due to the fact that it is driving up costs of a lot of these other goods as we go forward. So that is one that's going to be a tough one. And there is no doubt. I mean, this is not a debatable issue. It's not a Republican Democrat thing. There is a push in our country to go to more of a green energy philosophy. And so for one of the concepts is we have driven prices up a little bit. And again, it's debatable how much, but it is a factor by trying to make a transition fairly quickly to new energy sources. So as we go forward, those are some of the things that make up inflation that we have to deal with. Did want to briefly highlight, as I flip forward here, hang on one second, what's going on with wages. And we have seen, in just a quick look at this slide, what this is basically saying, it's kind of a busy slide, but what has happened is we have seen that inflation really has eroded away at the income on really an unprecedented way. Growth in wages and income after inflation has been negative really since May of 2021. So when you look at all those raised wage increases that we saw, I always use the example, if you listen to me do these webinars, I'll always mention Quick Trip. Quick Trip is a place I stop on an ongoing basis to get gas and whatever. But what I've seen is I've seen their wages in the last 2 years, year and a half, go from around $12 an hour up to $16 to $18 an hour, depending on what shift you're working. That's nice. I mean, it's great that those workers, and I think we've seen this across the board, have received those types of wage increases. The problem is inflation, back to the previous slides, has really eroded away at that. So what we're seeing is a lot of people are actually going backwards in their purchasing power because of inflation. Inflation is one of the biggest taxes you can have, especially on people in medium to smaller or lower income levels. Honestly, if you're sitting with $10 million in the bank, what happens is gas at $2 or $5 isn't going to change your lifestyle. But for the person driving to the construction job that is now spending in their truck, instead of spending $50 a week for gas, are now spending $100 a week for gas, that makes a big difference. So that does erode away at people's wages, which again is a factor into what we're seeing with some of these other charts you're going to see in just a second. Some things to look at that we're looking at. Durable goods orders are coming down. We've seen that overall that has been a decline of about 6.9% after inflation. This is one of the first things you see consumers start cutting spending on, is some of the expensive big ticket items. When you're looking at certain economic conditions deteriorating, and we are starting to see that happen more and more. There was a pent-up demand coming out of the pandemic. Now we are starting to see that demand has been met, and people are now starting to say, boy, I'm not feeling as good as I was. Consumer sentiment we'll look at is way down. I'm not going to buy that big ticket item. So that does make us a bit nervous as we go forward. Labor costs are soaring. I mentioned that. Auto sales are weak. You look at this, you can see that auto sales are actually pulling back. Now that should be good news, because we should start to hopefully see a thaw in some of the pricing of some of the used cars. Hopefully, we'll start to see a supply of new cars again to a degree. But it is one where this has driven inflation, but we are starting to see that is starting to come down again overall. I mean, it bottomed out in pandemic, came way back up, and now we've seen it come back down to a degree. The next thing I want to talk about is a little bit, I mentioned about labor costs soaring. You can see the difference here, and we've seen the cost of non-farm business sector has went up. The blue line has went up dramatically. You can see over here where this is at. Now, again, the sad part is a lot of people aren't, even though they've seen these wage increases, are not necessarily seeing they're keeping up with inflation. But labor costs have soared by about 8.2%. And that is part of inflation, because if you're a company and you're doing business, somehow you're going to pass those costs of higher labor, higher transportation due to energy costs, you pass those back to the consumer, which means that they're paying more for every good and service that they're buying. So that is a factor that we are looking at. So there is some good news, is that people are making more. Another indicator that I wanted to throw out and take a look at is, now this is a little counterintuitive. You're going to kind of say, well, why is this weakening? Comes a point here, especially when I mentioned copper and lumber are a couple that I threw in here. The top is copper. Then you see lumber at the bottom, and actually it's really slowed down with the housing sector slowing down. Here's copper right here. That's copper. This is oil. Now oil has somewhat, we've seen that stay at a higher level, but what happens is, and actually one of the things I wanted to mention all the way through this is actually good that this is happening. We want this to happen. This is what the business cycle does to correct itself. Now, the question is you hear about a soft landing, hard landing. How is the Fed going to orchestrate this? That's the concept that we have to figure out, is by the Fed tightening with interest rates going up. We saw we had the 75 basis point increase last week, 0.75, you went up 0.75%. They're slowing back on how much money they're putting out in the system. That how long is it going to take that to come into effect? Because what it will do with commodities, you will start to see commodities start to slow down. You will start seeing things like copper. You will start seeing things like oil. You'll say, well, how is that going to come down? How are we going to see gas prices come down? One of them be just organically, we're using less. Now that will happen if we keep seeing this economy slow down to a degree where people just aren't doing these things. You have the combination of high prices of energy, plus you're going to see that there's not as much manufacturing, there's not as much of those things going on, that will start bringing this down. We have seen ups and downs with this. I mean, if you will see maybe go from 5 to 485, I saw around here for a little bit of time, but it is going to be very volatile when you're looking at that. But we are starting to see some of these other things start to slow a little bit also, especially in this sector, when you get to the lumber sector, because the next slide I'm going to show is basically looking at what's going on with new home sales. Now, you can see here that we've seen a dramatic change in the whole concept of new home sales. We've seen those come down. Overall, the total market, we've seen that to slow down. Now, I know, if you look around, you're still seeing houses being sold fairly quickly, at least in our area. You get to the Milwaukee area around here, things are still selling, but what you are starting to see is some of the higher end stuff is starting to sit on the markets longer. When interest rates go up, and we've seen interest rates spike up dramatically on the mortgage side, again, they go up exponentially percentage-wise more than what you see when the Fed raises the interest rate. So what you're seeing that you're starting to get some 5-6% 30-year mortgages out there, where that's going to change the buying mode for a lot of people that qualified for stuff before. So again, this actually is, to me, a good bellwether that the Fed is doing is actually working. That's good. I mean, again, you're saying, why is bad news good? It gets us through this part of the business cycle a lot quicker than it would if we saw these things stay higher. And that's one of the biggest fears I have is, honestly, the government has to kind of constrain itself from wanting to make things seem great for us all the time. Because if they do that by pumping more money in, I know one of the things that's being talked about now, and again, I think we'd all love to see it, and I think it would be helpful. My worry is, where does the money come from, is relieving the federal gas tax. Now, if we did that, that probably would bring our gas down 25, 30 cents. But what happens is where is that money coming from? That supposed tax is used to fund a lot of our transportation infrastructure. So it's not like you're kind of creating money again here, or you're taking it from one pocket to the other. So we have to be cautious, because if we all of a sudden put a big stimulus back into this economy, it's just going to extend this longer, and the pain will be worse down the road. But this to me, I always watch new home sales and just current home sales as an indicator. And it's actually, I think it's, again, a good thing we're seeing that slow down. The key is see it slow down without crashing. I mean, we don't want to necessarily go back to dramatic levels back in here, but coming down to a degree is not a bad thing. I mean, we don't want, this was the spike time back that we had before the crash we had in 2007 and 2009. So you want to balance. Now, the Fed's challenge is going to be having the housing sector and some of these things being, quote, a soft landing. The next slide, I want to talk a little bit about consumer confidence. This is actually a pretty big deal. One of the things you'll find is about 70% of our economy, 68% of our economy, our gross domestic product, is really generated by the individual consumer. So that individual consumer is buying a lot of things. Now, when they start feeling bad about things, they quit buying as many things. And the question is that going to put us into more of a recession? What happens then, or how long will the recovery be to come out of that with what the action the Fed is changing? Now, what you're seeing is the June number, and that's what got the some of the things, the inflation number, and also this consumer confidence number are some of the things that got the Fed, saying we need to make sure we hit this head on. Now, what this does, though, it is saying that people are just not feeling good about where they're at right now. Now, you take this back, you go back to basically, for some of us old timers, you get back to the early 80s. And again, it's that similar feel that we have right now. Now, again, history lesson here, back in the early 80s, what we did is Volcker, who was the Fed chairman at the time, basically took some very tough action. And Reagan actually even knew he had to do it, but he fought it the same as any other politician would, because it makes you feel bad. I mean, you went into a recession from here to here. Now, what that does is, though, it did do the job. That inflation was much higher, and we did start to see that come down. But this is something that the University of Michigan does this survey on an ongoing basis. A lot of things going on. So this is actually, you can see the troughs that we've had over the years. That in planning for 2022 and behind, investors should focus on what sectors are going to come back out of this. And that's what we're looking at too, is the investment thought process. The next slide, I just wanted to highlight a little bit about what's going on with the oil market. Now you can see, for example, we kind of peaked up here when you look at June 16th of 2022. We're going to continue to see volatility in this range. So is there going to be a quick fix for oil prices coming down, for gas prices coming down? When I say oil, it comes back into the gas side. because we do have to look at where is production coming from. You can see, for example, if you look at the production levels, what we've had, we're still producing a decent amount. OPEC has stayed pretty normal as far as what they've done over the years. So the question is even though, how much consumption is there going to be? How much of this is going to start to go down? I mean, this is a very dynamic process that we have. So kind of the concept of Ukraine, the concept of what's going on in Europe, where the energy is going there, what's going on here with some of our production changes as they go forward. One of the keys is we want to make sure that that stays at a certain level, or if we want to solve some of the world problems, maybe increase it to a large degree. But this is going to be a nightmare for a lot of consumers, and it's going to be a political football that's going to be played out over the next period of time. But it is an important part that we need to look at. What I wanted to highlight here is recovery from bear market since World War II. I just wanted to give a little bit of perspective of looking at what's happened to markets when you look at this. So what's happened to the S&P 500 on a 1 year, a 3 year, and a 6 year basis after you've come out of a downturn. So for example, when we look at these downturns, you can see what we've had. We started at a 20% as a bear market. So if you look at 1946, from 9.9 to 517 we saw a decline of 28%. After 1 year, the markets S&P wasn't back yet. After 3 years, it was back 2.7. After 6 years, it was up 68. Now, 73, a tough time. After 1 year, it was still down. Again, that went from November 27th to 10.3. So you're looking a little under a year that downturn hit, that we were in that bear market. We weren't back after a year. Now you look after 3 years, pretty solid numbers. You can see the same thing. Now the one that was a tougher one here, you can see we went from this downturn from 312 of 01 to 912 of 01. We saw that took a little bit longer to come back. Now, one of the things that I'll talk to you about this time frame here with these downturns, this was kind of that tech bubble time. We had PE ratios, price to earnings ratios of stock, I mean, what you pay for a stock for how much they make of that company, it was out of this world. We saw some of the higher ones historically we've seen. It took a little bit longer to come back from that because we did have to get those PE ratios under control when we looked at that time frame. But you can see by that time, you look at a longer term period of time, we were okay. Currently, we don't know. I mean, we're experiencing looking at what's going. This was the pandemic time frame. We don't know at a 3 year or a 5 year yet, but we do know after 1 year, we were back from that downturn from 312 of 20 to come back. The start date here from 219 of 20 to 323 of 20. That's how long it took to come back. This was the bottom when it hit there, hit the 20% downturn. So when we're looking at these start dates and end dates, basically you can see how long it takes. Now the point of this is leading into kind of our next discussion is what do we do? How should we react to what's going on? Now, when you're looking at inflection points in the market, here's one of the things that we see. So you can see, for example, here, we're back to kind of where we were. We've seen this is the S&P 500 now. But one of the things I do want to focus on is some of these price to earnings ratios. Again, that tells us how much we're paying for a stock. Again, these are averages. The S&P 500 is just an index. It's not one company. But what this shows is if we go back and look, I mentioned kind of this early 2000 phase. What we saw here, we saw PE ratios get quite high. We saw PE ratios in the 25 neighborhood. And you go up and you can see, for example, 2007. We went into that downturn. The PE ratios weren't real bad. But it did take us a while to come back. And you look at this. Overall, as we're going through this, you can see what we're finding here is that as of now, basically June 16th, we're sitting in with a PE ratio, forward PE ratio looking at about 15.8. So we've come down from 19.2 at this peak. So the good news is that we are looking at some PE ratios that are getting more reasonable for stocks. Again, not a surprise. I mean, that's what happens when you basically start shutting the economy down to a degree, is companies' earnings will go down. Now, the key is we just don't want them to go down too far. Now, one of the things that we look at, and again, we've always said this, if you have a crystal ball, you get in, you get out, and everything's great. The problem is it just is not that easy. And anybody who says it is not telling you the truth. It reminds me of people I've known years that go to Las Vegas. Nobody ever loses. With this market, what you have to do is, one of the keys is, and we'll talk about strategy on how you handle this, and what we've been looking at is what we see is overall, we see the impact of being out of the market. Now, this is kind of a busy slide, so I just want to take a second and talk about it. So if you look at this, during periods of extreme market declines, the natural motion that we have is to take control. Our goal really is to kind of get out of the market. We don't want to lose. I mean, and this is natural. This isn't, I always tell people, never feel bad about calling when the market's going down. I mean, if you didn't, I'd think you're something wrong with you. What we have to do is we have to resist emotion and make decisions that are logical. Going back to the business cycle, going back to what the Fed is doing, trying to take a look at this. And again, but the most important thing is I need to know your time frame, because if you look at this, the results of this action can be devastating if you get in and out, because during periods of market volatility, the best days are likely to occur close to the worst days. This chart compares an individual who was fully invested for, the past 20 years in the S&P 500. If you miss some of the best days, you can see how it changes your returns. So if you stay fully invested, if I miss the 10 best days, if I miss 20 days, if I miss the best 30 days. So the key that we have here when we're looking at this is 7 out of the best 10 days occurred 2 weeks after the 10 worst days. So if we would have missed those 10 best days, what we're doing is we're cutting our returns dramatically. So this is one of the reasons why in academics and in practicality, we look at not market timing. I know it feels good. If I call you and said, let's get all out, I'm worried about the markets, which I am. I mean, there's some things I'm worried about, but it is not the right thing to do because we do not know the timing of a business cycle. We just do not know it. Now, what we need to do is understand your cash needs, and we'll talk about some of the other strategies that we look at doing during this period of time. But this really isn't a very important concept that we understand as far as the recoveries that we have. Now, another one is although volatility is unavoidable, it is a reason for investors to maintain a long-term approach rather than reason for pessimism. So the bottom line, when we look at this, over a 1 year period, the S&P has experienced gains as high as, if you go back from 1950 to 1921, we've seen returns gains as high as 51%. If we went back, and we've seen it go down. So we have ranges. So if you're all in stocks, that's why we don't want you all in stocks. You can see some big variations. Now, if you're all in bonds, you can have some variations. If you're in a combination portfolio over time, basically you'll see that what we're going to find is that our fluctuations aren't going to be as much. Over a 5-year period, you have a very small chance of actually seeing you lose money. Again, over a 1 year period, you got a 39% chance. Over a longer period of time, you can see you eliminate those. Now, with stocks, that's why we don't always say we're going to have all money in stocks, because there is a 1% opportunity that you could see a downturn. Now, you look at a balanced portfolio on a 5-year and a 10-year rolling period. So if I'm in a 50-50 stocks and bond portfolio, basically I have seen that they have not been down. Same thing with a longer period of time. I have a much lesser chance in a 1 year period. Now, just to state it, the chance is pretty high in this one because, again, rising interest rates has hurt bonds. So some of our bond holdings, although very solid, have experienced a downturn if you look on a year-to-date basis. But we do know if we have time on our side, we are going to see that the probability, and we do a good job allocating, that we are going to see that we will work through that process. Going back to, that's why we have to have time on our side. Now, when I look at longer time horizons, give markets time to work. The bars on the one, we have a 1 year time horizon. Basically, it shows $100 invested that were made 1 year earlier. The periods highlighted and gave represent periods when you see a loss for a 1 year horizon. So the bottom line to this chart just reinforces for me, and again, this is a little busy chart, that what we see is overall that if we have time on our side, that we are going to see that returns. Now, again, this was a little tougher time that we had there. Oh, went up a slide. In that 2000, early 2000 period, we did see a little bit longer time to come back, but it will. Now, this chart that I have up now, again, very busy, so I'm not going to spend a lot of time on it. It shows different asset classes. So when you look at the colors, for example, if you look at year to date, what asset classes have done better? Commodities. Now, why have commodities better? Mainly energy, oil. You look at BP, Chevron, some of those stocks have done very well. Cash. Now, you look at the other ones, there has not been a lot of positives here. But the key is, one of the reasons we do practice, as I say, market logic, not market timing. We use asset allocation as an underlying part of our process. Because what that does is, I remember I was actually talking with a class once, and they said, well, I just want to stay in the middle. I don't want the big ups and downs, so the whites are it. Now, if I knew what was going to be the hottest asset class every year, and we could predict that, we just go to that asset class, and I wouldn't, I'd be on a yacht somewhere probably. What happens is you don't know that, because this is all based on the business cycle. Because what you'll find, stuff that's at the top has a tendency to go back down. Stuff that stays at the bottom has a tendency to start working its way up. That is the business cycle. That is supply and demand. That is the consumer. That's what this does when you're looking at asset allocation. So our goal is to continue to practice asset allocation, not trying to guess what is going to be the next top asset class and go all there. Because I guarantee you, because I've done this, I've been doing this for 40 years, we will be wrong. You will be wrong. Now, the problem you have when you're doing this, back to that business cycle, when I was talking about the business cycle, one of the things I did want to mention about that business cycle is when you're in the business cycle, you'll find that when you're coming down in that cycle, so remember the phase I had us in earlier in that slide, what you'll see is you'll find that the markets are going to, the economy is going to continue to sound bad. So when you're looking at that, you're going to see that the business cycle will continue to sound not as good. The consumer sentiment won't be great yet. Inflation will still be there. Manufacturing won't be all ramped up. But what happens is, before you trough out in the business cycle, you want to start buying stocks about 6 to even 12 months, depending on how long the cycle is, before you bottom out in the business cycle. Because what that tells you is, again, you're not buying a stock for where it's at today. You're buying a stock for where it's going to be down the road. So when you're looking at buying that stock, you're saying, okay, I want to make sure I'm getting in on that and that's what the analysts are doing. They're saying, we see that Microsoft, we see that demand is going to come back for a lot of their goods and services. So we're not going to wait for it to hit the bottom. We're going to start buying it a little higher in the business cycle, up there before the economy troughs, because it's going to start doing better before that. It's a big thing to remember, and that's why it makes this process hard to look at. So when you're looking at, or hard to guess where it's going to be. So one of the things that we're talking about today is we do want to remain as calm as we can. Again, I'm never dismissing downturns. Again, I don't like advisors, and I've supervised literally 1,000 advisors over the years that say, don't worry, be happy all the time. Because you should worry. We worry. I mean, it's one where we should be worrying about what's going on. We want to be logical. We don't want to let emotion control this, because the people that I've had, and I have had customers, because the bottom line, it's their money, and they all want to get out. Problem is, we miss the upturn. And again, back to my charts, how many days are very close, the up days are very close to the down days. So we want to make sure that we don't let fear just totally grip us. So when we're looking at this, it is something that's very important to us. So when I look going forward, what causes a bear market? Again, I put out a paper on this back in 2020. Three things. You have a cyclical bear market right here. That's basically the business cycle. That's what we're going through right now. We have a structural bear market. That's a bubble. That's when something happens that there's a dislocation in the credit markets. This was the 2005 or 2007 to 2009 period. That was a structural bubble with the home mortgage world. We let that get out of control. There were products that were created that caused that. This is much harder to predict. This is one that can totally hit you out of the blue, which that did. This is somewhat predictable, and that's what the Fed is always trying to control. Then you can have what I call the pandemic one, which is event-driven. That's triggered by an event, political instability, war. Now, to put this together, we do have a little bit of that in this at the same time, which is what probably caused the Fed to have a problem in reacting as quickly as they probably should have. Because the Ukraine thing, I don't want to downplay that. That did make a difference. But this is what happens. This is why we have bear markets. This is not a, excuse me, an unknown event. We see this. The problem is predicting the timing of it. Now, what choices do we have? And this is something that I talk about on an ongoing basis. You know, there is the get out strategy. That's a tough one because I'll state categorically, the get out strategy is easy. The get in strategy is much harder because the time you start feeling good about where the market's going, the market will already have gone and you're going to miss those days. Now, the concept is then you have the stay in strategy. Don't do anything. Everything's fine. Everything will be great. That could be, and that works. If you have time, the stay in strategy will work for you. The problem I always want to address with the stay in strategy is when I do have people that are in retirement, I do have people that we have to depend on a monthly income. We need this this will work, but we just may have to make sure that we have, this is the one that's very important. They're all important that we have that bucket strategy, but this is really important. We have the combination strategy. To me, this is probably the best one where we say we're staying in, but we are going to make some adjustments. We are going to say we're going to stay in, but we're going to start saying there's some things that I may want to get out of that I just don't think are going to come back as fast. We free up some cash. We look at saying what opportunities there are. And actually, I've been doing this more with the bond market than I have with the equity market. If we own good things in the equity side, we're going to ride them through. The bond side's been a little tougher because everything has been getting the bond side. So that's where you look at saying, okay, if I have anything that's very long duration, very long as far as maturity, I start going to more cash. You know, in this one, I don't state this in a kind of a glib way. There is a way that I have some people, I've had a couple of people say, I just don't want to go through this again. You know, all what you're saying makes sense. We're going to go up, we're going to go down. We'll be okay over a period of time. If it does come to a point where you say, I don't want to do that, there are strategies that we have. Now, what's going to happen is, I just categorically state this, you're not going to get the big upsides. I mean, you know, when we had these up markets, again, we're back to 2019 levels, but we've had a nice run up until 2019. So you still made a lot of money. It's just we haven't kept it quite as much as we'd like in the recent days. But what happens is, if we do this, we can do it, but it's going to be much more of a strategy that's going to preserve more than it's going to grow from that standpoint. But that's the choices we're always looking at we have. And I know we're running a little bit long here. Let me take a look at a couple other slides. Now one thing I wanted to do, I went over a lot of stuff very quickly, but again, bucket strategy, very important. That is a real key item that we must make sure that we have is that money either short-term, medium-term, or long-term, depending on what your cash flow needs are. It determines how we can withstand the ups and downs of a business cycle. Again, this isn't a bad thing we're going through. This is actually good, but the problem is how will the Fed land this situation? Now, if we take a look at this, I do have some questions. So I am going to run through these questions. One is the recession matter of when and not if. Right now, in some of my papers here, I have the probability of a recession. I want to say the Vegas has it at 48% right now, if you want to bet on it. So it's about a 50-50 that we are going to have a recession. Personally, again, a recession is 2 negative GDP quarters where we don't grow. I kind of agree. I think it's about a 50-50 mix that we have. There's a lot of variables to be played out here. The key will be not slowing it down too much. The good news is the labor market's still very, very good. We still have a lot of people working, so we still have income coming in. When you start seeing the labor market start to back off a little bit, which we have just a hair, but still we have a lot of people working, still a lot of cash flow out there. If we can get this inflation down somewhat, we'll see that that will make a difference. Do most advisors use the business cycle, or is this something that Oaktree focuses on especially? No, I mean, we're all using the business cycle. I probably emphasize it more. Again, it's a little more academic. It's not a, something that you do have to take a little bit of time to understand. I just believe, and this came to me about 25 years ago, that it was the one thing that I could look at that was somewhat factual, not necessarily like a clock ticking, but it is somewhat factual. How much is Congress and the recent spending packages and infrastructure and COVID to blame for this inflation? Oh, quite a bit. Yeah, I think realistically, history will tell us that the last package that we passed, that we put out there, probably wasn't needed. A lot of that cash just, went into supply as far as putting cash in the system. People bought things, drove up prices. We had the supply line shortages. We had the shortage of things. We hadn't built back inventories yet. And that we have actually built back inventories now quite a bit. But yes, I will think, and history will tell us that yes, we probably were too generous in how much cash we had in the system. How will we know when we're out of the bear market? You will start to see things start to flow. I mean, we get all these statistics that we look at, and we are seeing that, for example, that, usually what happens is the Fed policies will definitely see downturn. We're going to see numbers get worse, but then you start to see some thawing in inflation. You start to see the right avenues. Again, personally, this is my personal view. The worst thing we can do is throw another 5 trillion or something into the system right now. We really have to make sure that hopefully our politicians have the fortitude not to want to make us all happy quickly. And again, that's the problem I have and that's why the Fed is supposed to be completely agnostic as far as their view of politics, because they should not be driven by getting reelected. That's why it's a very important part. Are people going to need to delay retirement and work for years longer because of this, all of this? First of all, if we've done a good job planning your retirement, the answer is no. I mean, if we've sat down and went through a retirement plan, make sure we have our buckets corrected, we'll be okay. And we go through our clients on an ongoing basis to make sure that if you're a person looking at retiring, part of this is going to make it how you feel. I mean, it does make a difference. Now, talk from personal. If your account's at X, your account's at X minus, you don't feel good about it. So there might be some people that will extend their working a little bit longer. Hopefully, from a retirement standpoint, if you've done your planning, retirement planning is very important that we do that. I feel helpless to do anything about this mess we're in. Well, you have choices, I guess, at the ballot box. You have choices on how you're spending your money. You can make personal choices that way. There are some things that are out of our control. But again, if you determine you want to go a different path, this is a democratic world, and you get a chance to change that every 2-4 years or whatever it is, because there are different policies. But I do have to put this caveat on. The politicians don't necessarily direct a lot of this. I know you're saying, Brad, what are you talking about? On the peripheral, yes, they do make a difference on some of how long the cycles go. Are they going slower, faster, certain issues? Honestly, a lot of presidents, if you back and look historically, have really benefited from where they come in the business cycle. I mean, if you come in and you're the president at the right time of the business cycle, you look fantastic. If you're not, you don't look as good. So part of that is circumstance. Now, you can make a difference as a political entity on how you handle some of these things. But those are things that, again, I think sometimes we think that the politician can control the business cycle completely. And that is a tough one to do because it will play out. It is, again, something that's going to work its way through the process. Okay, we went through a lot here. Last question I'll hit is view on foreign holdings. We like them, just not yet. The PE ratios, and I've got a bunch of charts and graphs that I can show you on those. We won't go into those. Really, foreign investing would be a whole different webinar. That what you'll see is that you will see that foreign investing, some of the PE ratios in a lot of the other countries look very good. And plus, as our dollar is doing what it's doing, probably makes it look even better for them. So it is situations where down the road. Now, normally they are a little bit behind us as far as controlling parts of the business cycle, raising interest rates. Now, we have seen that the EU and Swiss and some of the various interest rate, the banks have changed. So they are addressing these problems with inflation also, because they have it too. But I do think coming out of this, that a lot of the PE ratios there are much more attractive than ours were, and they actually are quite lower than ours. So I think a lot of those companies, and plus too, as we open up the world again, that will be there. Okay, I know we're sitting here at 12:20, and I want to keep this to about 45 minutes. We covered a lot of information in a short period of time. In summary, the buckets, make sure we understand and we're communicating about how much we need short-term, medium-term, and long-term, because that really determines how we handle this. We're going to continue to work through the business cycle, monitor the business cycle, look at weightings to make sure that we are taking advantage of certain weightings. Again, not going to violate asset allocation, not going to go all or nothing, but we will tweak the asset allocation to look at asset classes that do better in certain parts of the business cycle. Just common sense in my mind that we look at. Continue to monitor bonds. As interest rates go up, it's going to be harder on the bond market. It will get to a point where that will stop, and the bond market will be a great place to be. And that's getting closer than we think, because we are starting to see that with some various types of bonds. So those are things that we're going to be looking at going forward, is making sure. Some upcoming things that we're going to do. I'm just going to highlight this for the people on the call. We do have one of the things I'm going to do a webinar on the 30th on Roth conversions. You know, one of the things we look at, if you have an IRA, depending on your tax bracket, there's a lot of variables. Sometimes it makes sense to convert your Roth to or your IRA to a Roth, so you have that money sitting on a tax-free basis. So if I bought XYZ stock at 100 and now it's 50, I may want to convert that stock at 50 to my Roth IRA. Open up a Roth, or if I have a Roth, can move that stock over. Then if that stock goes from 50 back to 100, I just have increased my amount that I have that I can take out tax-free, because that whole gain now is all tax-free that I brought back. Now, remember though, I would have had to pay taxes on that $50. We're going to talk about that in detail, the pluses and minuses. So we're going to have that on the 30th. You'll see that on our website. I want to continue to communicate on ideas like that. And I'm trying to mention it to every client as we're talking with them as we go forward. I want to thank you for your time. If you have any questions, feel free to give us a call. We're here to answer any of your questions and to make sure that we continue to monitor the business cycle. And again, don't let emotion drive your total theories, because what will happen is over time, it's been proven that that is not the way to go. Hard to control, but it is an accurate statement. Have a great day, and thanks for joining our webinar.